All right, joining us now, Alec Young, Managing Director of Global Markets Research at FTSE Russell, and Kevin Mahn, Yaman. You told me that. You shouldn't have given me that. You're very popular in Jamaica. Cool running. President and CIO at Hennion and Walsh Asset Management. I'll start with you, Kevin.
Yes.
That was the story last week, and I was just positing whether there's something we don't know. I mean, 18 months is a long time. Given the current economic forecasts, a recession looks really unlikely.
Yes.
I'm just wondering if is there any way a yield curve could actually know something that we just don't know? You never know what you don't know. Or can we just say it's different this time and probably not likely to be correct?
I don't think you can entirely ignore the yield curve inversion, but with record low unemployment numbers, moderately rising wages, a confident consumer that continues to spend, the fact that the tax cuts are going to stay at least through the end of next year, a more lax regulatory environment, that should bode well for stocks. And now with the more dovish-leaning Federal Reserve, there are opportunities there. I think the bond market is telling us they'd like to see rates lower, but I don't know if they necessarily need to be.
And just wondering, you can think of so many, and I use the term exogenous events, an oil shock or something in Hong Kong that really, 1.7 million people. I mean, that's hard to put the things back in. I mean, what's starting to happen there? I don't think it could be that smart, but then it just makes me wonder. We have 18 months is such a long time, and especially with the news cycles we have now, that I don't know how you can say that we know there won't be.
There's a lot of risks.
There are things that are pushing the yields down and flattening the yield curve.
That have nothing to do with the economy.
With our economy.
Right.
So there's a global savings glut. And
got it.
It's weird. I mean, there's a lot of stuff that you hate to say this time is different, but there are some pretty unprecedented things going on. People are talking about negative rates here eventually. Right now, that seems like a stretch because of the strength of our consumers. So we're in this weird world where we've got ultra low rates are collapsing, but our economy's healthy. I don't think we've ever had that before.
I mean, Brian Moynihan spoke last week and said that he didn't see anything out there. Bank of America has 1 out of every 2 households in the United States, and usually banks can see it out by about 18 months.
But I think from an equity perspective, there's a couple things you can take from that. Number one, it's encouraging. It means the market doesn't fall out of bed, dips get bought.
Yeah.
The problem is that until trade gets resolved, no one believes these consensus earnings expectations.
Right, you're not that bullish.
No, I think we're bouncing around. I mean, I'm glad that the strong consumer keeps us out of a major drawdown. But right now, earnings growth, as you guys know, is low single digit. Right. The street is at 11% for 20 over 19. Buy-side people look at that number and they say, we'll be lucky if that's 5. So until you get rid of the current tariffs and they agree not to slap new ones on left and right,
even with what
I think
Walmart
the market
said,
doesn't make new highs. We're going to bounce around.
I mean, I was surprised that Walmart would really go out on
the market's differentiating between the consumer names are rocking and rolling, but the globally hurt names are in the tank. There's huge swaths of the market that are a train wreck. Energy, and I think there's probably value there, but financials, most pharma. There's a lot of parts of the stock market. It's very bifurcated. There's a high-class stock and a low-class stock.
Do you think that it's tough to do double-digit earnings returns? I mean, it's a very positive environment for U.S. companies. Maybe globally, not so much, but in terms of unemployment and GDP.
I think if you look back to 2018, Joe, we had 2 consecutive quarters of year-over-year corporate earnings growth of more than 20%.
So these are still tough comps. These are still tough.
But we're in a slowing but growing environment. I think that's constructive for stocks. I think we have a lot of geopolitical risks. Boris Yeltsin trying to navigate a hard Brexit. We know Merkel's not going to run again for re-election. We don't know what's going to happen with that final round of tariffs. Fortunately, that's pushed out into December.
Boris Johnson.
Yes. So we don't.
I think that other guy's dead, right? Isn't he? He stood in front of those tanks or something.
The other thing that's interesting is that obviously, and we'll hear from the ECB this week, but the market's betting a lot on the Fed and easy money, and you have to wonder, the cost of capital's record low. So is the Fed cutting rates really going to stimulate CapEx and business investment, which is the weak spot of the economy? I kind of question that a little bit.
Why are stocks moving up so sharply today? Is it because Peter Schacknow says that he thinks it's because yields are firming up? That makes as much sense as anything else to me.
Yeah, no.
I think it's a reminder of how strong the underlying economy still is at this point in time, and the fact that we're moving 8 basis points now from a yield curve inversion gives some confidence.
I think the bond market's a big part. Also in Hong Kong, there was no violence. Huge rally, but I think the market over there, the market here is taking its cue from over there. Got a big relief rally that at least it wasn't,
That was because of China's central bank, too, though, the rally in Chinese stocks.
Yeah, and I think that tweak they're making to their
lending.
Yeah, be helpful.
So you think 5% year over year is as good as we're going to do for earnings?
I think that's constructive as well. I think we're going to have a strong third quarter. I think holiday shopping sales will be strong. I think the online commerce segment of retail spending will continue to grow.
So what will 18 months of no recession, that will put the length of this expansion at, I mean, every day is a record, right?
Yep. I wouldn't be surprised to see us hit all-time highs again, but there's going to be short-term bouts of
volatility.
The only problem,
but the expansion is long in the tooth. That's why it's not so hard.
Yeah, and I think what happens is people keep second-guessing it. People bet on mean reversion. So because of where we are in the cycle, I think there's a good chance it lasts a lot longer, but people, I think, will continue to second-guess it. Yeah. The problem I have with stocks here is just if we're in a 5% earnings growth environment, we're fully valued at 17 times. You're not going to get a 20 multiple on the S&P or the Russell 1000 without, at least 8, 9, 10%.
See, if I was a worrywart, I would say, okay, we're long in the tooth. You got the yield curve.
Bouncing around.
And then I'd start talking about Iran, North Korea, China, Hong Kong. I can give you, I'm so worried about so many things that in 18 months, I have no idea. We never know.
Forgot about Afghanistan.
Over in Russia, they got these stations that measure radioactivity. They like turn them off.
Yeah.
When that happens.
Because of the, right.
They're like, what? Oh, no, we're not registering anything. Yeah, you turned your stations. I mean, anything can happen.
We got a pretty big election coming up next fall as well, and that's going to
introduce some more
volatility over this.
Biden, Warren. That's my new pick, Sorkin.
That's your pick?
That's who I think it's going to be. I think it's going to be Biden, Warren.
But it's a little early for the market to be trading too much on that because we don't know enough about it. I mean, Trump wasn't expected to be anywhere near the victory, taking a victory lap at this point before.
But historically, 6 months, 8 months prior to an election, CapEx, if you think CapEx isn't going in the right direction already, it goes down materially.
Really, that's a great stat. I didn't know that.
What happens?
Because everybody sits in their hands.
I mean,
and they go, what's about to happen? I can't do anything.
Biden, Warren.
I think the closer Biden and Warren get to the White House,
well, think about it.
Frankly, no.
For the economy, that's like the sum. That's like add all those things I said together. Yeah. That's the sum of all fears. If those two get in.
One thing I can tell you,
if Biden was the president, it'd be different than with Warren. I mean, I think if Warren
Bernie, what if it's a Warren
got closer,
Bernie?
you'd have a different situation.
She'd take Veep, and then he goes one term, right?
I have no way. Under your scenario, under your
my
hypothetical scenario,
exactly.
Maybe. Yeah. I don't know.
One thing that's interesting, I've seen a lot of polling, investors overwhelmingly see Trump reelected.
They do?
Today, yeah.
As of today, they do.
Sure. Yeah.
It's 53-40. I like where they come out and they say 50% didn't like his response to the shootings. It's like
he said investors.
No, I know, investors. But 50% hate him. No matter what.
I'm just talking about portfolio managers.
Okay, those greedy. All they think about is their pocketbook. We don't want to. I don't even want to give them credit for that. Anyway, thank you, Kevin, Alec. Thank you.